Okay, today we are going to talk about debits and credits. And you have to think for a moment, what does debit mean or what does credit mean? Okay, well, debit simply means the left side of the account. And credit means the right side of account. Both accounts are going to have left and right sides, but the left side we're going to call a debit side, and the right side is going to be the credit side. Credit doesn't mean good or bad, it doesn't mean increase or decrease, it would depend on that account. Same with debit, it doesn't necessarily mean increase or decrease, it depends on that account. The other thing about debits and credits is that they have to equal. You might remember that debits equal left because we say debits and credits, left and right, the way we read left to right. But always remember that debits have to equal our credits. In our accounting equation, we discussed how assets have to equal liabilities and owner's equity. Well, our debits also have to equal our credits. And so for every transaction that we have, we said before that they have to affect at least two accounts. Well, those accounts, one is going to be debited and the other is going to be credited, and there have to be equal amounts on both sides of that. A way to think about debits as we analyze transactions, and we're going to be doing that shortly, is that the account that we are going to debit is what we receive. So when you analyze a transaction and you read through it, say, what is the business receiving that transaction? That is going to be the account that you are going to debit. Then ask yourself, what did the business give up in that transaction? What they gave up, or what they give, is credits. So, you've heard of the expression, give credit where credit's due. Well, in accounting, we're going to give the credit where credit's due. So that might be just a little aid to help you remember that. Okay, so the debit, we said that was the left side of the account, and the credit is the right side. So let's incorporate that into our accounting equation and see how all these pieces fit together. Our accounting equation, our assets equal liabilities plus owner's equity. And so underneath these, I've put what we call T accounts. They look like the capital T. And again, the left side is a debit side, the right side of the T account is the credit side. Debit always is left, credit is always right. But note that under assets, a debit is going to increase the asset, where a credit to an asset account is going to decrease it. When you go to the other side of the equal sign, it's like a mirror image. It flips over. It's just the opposite, in that here a debit is a decrease, but we credit liabilities to increase them. Likewise, we credit owner's equity to increase it. We would debit the owner's equity account to decrease that account. So let's just run through an example or two about this. And I'm going to identify this account as a cash account, as an asset account. And our liabilities, I'm going to say this is notes payable. And for my owner's equity account, I'm going to have my Jim Smith Capital. Now, let's say that Jim Smith invested $5,000 in the business. Took it out of his personal funds, put it into a business bank account, and designated it as the business money. Well, what did the business receive? The business received cash. So we said that what we receive, we are going to debit. So we would debit our cash account for $5,000. what did we give up? Well, we gave a promise to pay to the owner for $5,000. So what we give, we credit. So in this case, our accounting equation, our assets equal 5,000, our owner's equity equals 5,000. But in this particular transaction, we debited the cash account for 5,000 and we credited Jim Smith Capital for 5,000. That helps us keep in balance. Let's say that we borrowed some money from the bank. Let's say we went to the bank and we got a loan for $2,000. And we signed a note payable to the bank that we were going to pay that note off in 60 days. So again, ask yourself, what did we receive in that transaction? Well, we received more cash. We received $2,000 cash. Every transaction has two parts. So we asked ourselves, what did we give in that transaction? Well, in this case, we gave a promise to pay to the bank, and we call that a notes payable. What we give is what we're going to credit. So we're going to credit notes payable. Again, for every debit, we have to have an offsetting credit. And it's similar to Newton's third law of motion. For every action, there's an equal and opposite reaction. Well, same in accounting. For every debit, there's an equal and opposite credit. Notice that in each of these, we had to have the exact same amount. So now, on our asset side, we would have 7,000 of assets, liabilities of 2,000, capital of 5,000. Our accounting equations in balance. For each of these transactions, we had a debit and an offsetting credit, so each of our transactions are in balance.